Dennis Foster is a senior lecturer of economics. He'll be speaking next. Ron is going to speak on regional economic issues. Dennis is going to talk about interest rates and inflation. Dennis has been here, he's a short timer, he's only been here since 1990. So he's finding his way around. He'll be fine.
Thank you very much. It's always a pleasure to be here to speak to this particular group at this particular event. And I don't know about you, but I am really stoked. I am very excited. I can feel the electricity in the air, the underdog story. It just overwhelms everything. Of course, what I'm talking about is the Super Bowl champion. I've watched it like 5 times and they keep winning, so I'm pretty excited about that. Probably thought I was going to talk about the Cubs. I don't do baseball, and with all due respect, I don't do cows either. In case that comes up a little bit later. I do have a little bit of an announcement today. Elliot and Ron and I have started a little venture to try to earn a little bit of money out of this thing. We call it the Old Economic Outlook Conference Store. We're going to sell some items that we think that you'll enjoy and that, again, will kind of land in our pockets. This year we thought we'd do a little political theme, so we came up with a button that says, I'm with them. And that's pretty cool. And you might want to buy this cane hat, which says, make America's GDP great again. The problem is, those haven't arrived yet, and the election's over, so I think we misplanned this particular deal. So we're going to have to cut prices, I think, for sure. Although I think in the years to come, I wouldn't be surprised if you see them in some third world countries, along with Carolina Panther Super Bowl champions. One more chance to mention that. I'm going to get a little bit more serious here today. A little overview of my presentation. I want to talk about the current state of the economy. Then I want to talk about the Federal Reserve and its policies, its expectations, and some of the effects, assess some of the effects that we've been seeing here over the years, and then provide my particular economic outlook for the near term. Now, this particular chart, you've seen this one before. This is the aggregate growth in real GDP starting from the bottom of the last 4 business cycles. So what you see there is we're now 29 quarters after the bottom of the last business cycle. And at this particular stage in the 1980s, under President Reagan, our economy was 36% higher. Under Presidents Bush and Clinton, we were at 29% at this stage. Under President Bush II, we were 18% up, except that the recovery was already over. So it was over 4 quarters earlier, and we were already in our recession that we had last time. And with the current recovery, we're up just 16%. This has been an ongoing concern for years now, and it continues to be a concern. It's still a concern to me, and Ron mentioned some of these things just a couple of minutes ago. Another way to see this particular data is to look at the average annual growth in real GDP starting from the bottom of the business cycle to the next peak. And you can see again during the 1980s that was a little over 4%. In the 1990s, 3.6%. In the 2000s, 2.6%. And with our last recovery phase, just a tad over 2%. And I think most people think of 2% as being sort of the baseline just to keep our standard of living constant. So again, that's very troubling. And that goes along with some of those productivity figures that you saw just a few minutes ago. So what about the Federal Reserve? Let's talk about that, put that into the story here. What does the Federal Reserve want to have happen to our economy? This is really the list of the charges that they have. They want to promote healthy growth in production. They are charged with maximizing employment, with stabilizing prices or pursuing stable prices, and also pursuing moderate long-term interest rates. Now the question is, how does that happen? What is it that they look at in order to accomplish those particular outcomes? And the answer is they look for a strong and healthy financial sector. So from their perspective, if the financial sector is strong, then that's going to lead to those particular outcomes that they find favorable, and we all find favorable for our economy. So what's their theory of how all this works? Well, their argument is that a strong financial sector is going to lead to more spending. If there's more spending, that's going to lead to more production, that's going to lead to more economic growth, that's going to lead to more employment, and things will work out as a consequence. How that actually happens in terms of the Fed's, the mechanics of Federal Reserve policy is they increase the money supply, which drives down interest rates. So what the Federal Reserve does is increase the money supply, drive down interest rates, try to create a healthy financial sector to stimulate these particular outcomes. But as we've just seen, our economy is not really performing very well. Let's take a look at some of the data here just to show you. You saw this a couple of minutes ago. Another graph from the St. Louis Federal Reserve. This is the monetary base, which the Federal Reserve has more or less perfect control over. And going into the last recession, that was $850 billion, and currently sits at $3.7 trillion. And that is unprecedented in the Fed's history. You can look at that graph going back 100 years, and you're not going to see that kind of a dramatic change. And the big question is, what is that going to lead to? It hasn't led to really strong economic growth in our economy, but I think it will lead to something that won't be very positive. Here is the federal funds rate of interest, which is the rate of interest over what the Federal Reserve has the most control over. And you can see the shaded in area shows the last recession, and it was a little over 5% going into the recession. And they engaged in their monetary policy and pushed that rate down to essentially zero. And that's where it stayed for about 7 years now, 7, 8 years. And that's also unprecedented too. We've never seen the Federal Reserve push this rate down to zero before, and we've never seen it stay this low this long without the economy recovering. Here's a look at a little broader spectrum of interest rates. I've got the 3-month U.S. Treasury rate here, which really mimics the federal funds rate of interest that you just saw a minute ago. Going into the recession, it was about 5%, and then pushed down to about zero as a consequence of Federal Reserve policy. The 10-year U.S. Treasury, I think that actually has bounced up here the last couple of days, but we can see that the Federal Reserve doesn't have as much control over longer-term interest rates, but it still does push them in the same direction, generally as the short-term rates. And you can see those have come down from about 5% to a little under 2%. Excuse me. And then finally, you've got 30-year mortgages running between 6 and 7% before the recession, and down around 3.5%. Of course, that describes the spectrum, really, of interest rates that we have. So, in assessing the policy of the Federal Reserve, here's really what we have and where we are right now. Interest rates are at historic lows. I refinanced my home a couple of years ago. The monetary base has gone up, as I mentioned. It's over $3 trillion. And where has that gone? Well, it hasn't gone into more spending and more production and more employment as much as we would think it would. Instead, it's gone into bank reserves. So it's sitting in the banking system, available to be lent, but not being used. Economic growth, as I mentioned, as you just saw, has been relatively poor. The only good news is that inflation, as measured by the CPI, has been very low. And if you look at all the recessions for the last 50 years, every recession is preceded by an uptick in inflation. And we certainly don't see that right now. Now, we do see bubbles in the economy. Of course, the last recession was noted for the housing bubble. And so I would suggest here that we sort of think about what might be the next bubble. And I'm not, I'm kind of swayed that the stock market might be that bubble. Stock prices don't factor into the CPI. They don't factor into the official inflation rates. But certainly what's been going on there tends to look a little bit like that kind of outcome. So let's take a look at some of that data. Here is the CPI going back 10 years. The zero line there is the one in blue. And you can see that leading into the recession, rates were going up a little bit and have come down. The current rate as of September was 1.5%. The red line there is at 2%, and that's been the Federal Reserve's target for a while. They believe that stable prices is consistent with 2% in inflation. Here are bank excess reserves. That graph looks a lot like the monetary base graph because that's again where the monetary base is largely gone. Going into the recession, the aggregate level of excess reserves in the banking system in the U.S. was under $2 billion. As of now, it's a little over $2 trillion. Now, this is money in the banking system that they could lend out if they felt comfortable about who was borrowing it, and if they were optimistic about what was going on in the economy in the future. And then here is the stock market performance of the last 10 years for the S&P 500 and the NASDAQ. The lows were in March of 2009, and then the highs, I want to say the highs, it was 2 days ago. I'm already obsolete here in terms of the numbers. The NASDAQ is up 267% from its low during the recession. The S&P 500 is up 183%. Now, what the Federal Reserve looks at is they see that and they say, well, that's a sign of a strong financial system, a strong financial sector. But again, it hasn't translated into all of those positive outcomes that we would hope for in terms of the economy. So what is the outlook? I have been saying for a few years here, and I continue to say that it's excess bank reserves that are our biggest threat to our economy. And that threat comes with increased optimism about the future, which is really kind of a terrible thing to say. That's like, well, we want people to feel optimistic about the future. Well, if they do, and banks start lending out this money, well, that's going to stimulate some production, but it's likely to result in quite a bit of inflation. Now, a week ago, I didn't really put much stock in there being an increase in optimism, but today I tend to think that there may be just a little bit more in that particular regard. With regard to the specifics, I believe that interest rates are probably going to stay where they are for the next 6 months next year. With all these excess reserves, even if banks do start lending more money out because of some increase in optimism, I think interest rates will tend to lag behind in terms of their change. With regard to inflation, I think that's a little bit of a different story. I think that will start creeping up, and I wouldn't be surprised if a year from now the rate is either at the Federal Reserve target of 2% or maybe even a little bit higher. And that, I think, will be a troubling sign in terms of how we're going to deal with what comes after that. Now, I thought I would add in another slide here on some of the challenges in terms of the outlook for Donald Trump, given that he was elected. A slide that I had to put together yesterday, and not having expected any of this. But the challenges would have faced Hillary Clinton too, but I think that she would have continued with President Obama's policies, and so it wouldn't have been that big a surprise in terms of what we would expect to see. But I think for President Trump, there's a couple of issues here we can mention. The first challenge is how do you spur growth in the economy without triggering inflation? That is going to be a challenge. I think there's a couple things that he may be inclined to do that is going to work at least to some extent in this regard. One is to reduce regulations and reduce the burden of regulations. That should stimulate some economic growth without triggering inflation. A second thing that we're likely to see is a shift of some government policies, notably the Affordable Care Act, from the government sector to the private sector. I can imagine that is going to be a horribly messy thing to do, but at the end of the day, I think that could be a positive as well. The second challenge is how do you diminish the inflation threat without actually causing a recession? And I'm not sure that there is a positive answer there. I'm pretty sure that we're going to have to see that no matter what. I'm not sure that 2 years from now Hillary Clinton will feel good about losing the election because of it, but I think that it's going to be inevitable. And I think in this regard, what Trump has to do is he has to convince the Fed to try to undo its quantitative easing programs. The Fed doesn't have to do what the president wants. They don't answer the president. They don't answer to Congress, although they're always very willing to work with them. But I think he's going to have to find a way to get them to move in a different direction. Although I think, again, there's probably going to be some negative consequences that fall from that. Well, as usual, I'd like to end on a more positive note. So this is my top 10 list today. This is the top 10 people we'll miss from the presidential campaign. Not. Number 10, Tim Kaine. Number 9, Bill Clinton. Number 8, Bernie Sanders. Number 7, all of the debate moderators. Number 6, all of the talking heads. Number 5, Anthony Weiner. Number 4, all of the pollsters. Number 3, Bill Weld. Number 2, James Comey. And the number 1 on the list here, people will miss from the presidential campaign, not all of the mainstream media. Thank you very much.